Hello, dear partners. Let me introduce myself. My name is Anna Pirtxavaishvili. I'm a project assistant in Georgian Association Women in Business. We are Georgian partners at the Efeb network. Welcome on our webinar. Today's topic is access to finance. So let's get started. Banking products aimed at business startups and SMEs. Micro businesses require working capital for startup. The SME bank may be able to help you grow your business and provide you with financing or business development advice. How to grow your business? There are special schemes which have been established to promote entrepreneurship across priority and growth sectors. These schemes are working capital for the purchase of raw material, stock and overheads, term loans, hire purchase and leasing for asset acquisition. For example, for furniture, fittings, computer machinery, equipment and vehicles. And the last one is mentorship and advisory services on the preparation of bankable business plan, bookkeeping and cash flow management. Now let's talk about what banks look for in a lending application. As you see here, here is a 10 points. First one is collateral. Let's talk about collateral. In order to apply for a commercial loan for your business, you have to have hard assets it can pledge to back up a business loan. Banks look very carefully at these assets to make sure they reduce the risk. The need for collateral also means that most small business owners have to pledge personal assets, usually house equity, to get a business loan. Second one is business plan. Commercial loan applications require business plan document. Nowadays, it can be short, perhaps even a lean business plan, but banks still want that standard summary of company, product, market, team, and financials. Now let's talk about lean planning. How to plan less and grow faster. First one is overall information. That includes all current and past loans and debts incurred, all bank accounts, investment accounts, credit card accounts, and of course, supporting information including tax ID numbers, addresses, and complete contact information. Second is complete details on accounts receivable. That includes aging, account-by-account information for checking their credit, and sales and payment history. Now, let's talk about third scheme. Business financial details. That includes all current and past loans and debts incurred, all bank accounts, investment accounts, credit card accounts, and of course, supporting information including tax ID numbers, addresses, and complete contact information. Fourth one is complete details on accounts receivable. That includes aging, account-by-account information for checking their credit, and sales and payment history. Fifth one, as you see here, is complete details on accounts payable. That includes most of the same information as for accounts receivable, and in addition, they want credit references, companies that sell to your business on account that can vouch for your payment behavior. Six is here complete financial statements, preferably audited or reviewed. The balance sheet has to list all your business assets, liabilities, and capital, and the latest balance sheet is the most important. Your profit and loss statement should normally go back at least 3 years, but exceptions can be made occasionally if you don't have enough history, but you do have got good credit and assets to pledge as collateral. You'll also have to supply as much profit and loss history as you have, up to 3 years back. So regarding audited statements, having audited statements means you've paid a few $1,000s to have a CPA go over them and take some formal responsibility for their accuracy. CPA get used over bad audits. The bigger your business, the more likely you'll have audited statements ready as part of the normal course of businesses for reasons related to ownership and reporting responsibilities. Now let's talk about 7. Personal financial details. This includes social security numbers, net worth, detail on assets and liabilities such as your home, vehicles, investment accounts, credit card accounts, auto loans, mortgages, the whole thing. For business with multiple owners or partnership, the bank will want financial statements from all of the owners who have significant shares. Now, it will be 8, insurance information. Since it's all about reducing the risk, banks will often ask newer business that depend on the key founders to take out insurance against the death of one or more of the founders. And the fine print can direct the payout on death to go to the bank first to pay off the loan. Ninth one is copies of the past returns. I think this is to prevent multiple sets of books, which I think would be fraud, by the way, but banks want to see the corporate tax returns. 10th and the last one is agreement on future ratios. Most commercial loans include what we call loan covenants, in which the company agrees to keep some key ratios: quick ratio, current ratio, debt to equity, for example, within certain defined limits. If your financial fall below those specific levels in the future, then you are technically in default of the loan. Now, let's talk about SME loan segments in Georgia. You can see here the microloans, which are up to 50,000 USD. It includes small shops, beauty salons, small auto service centers, guest houses, schools and preschools, cafes and bars, bakeries. Second is small loans. It is 50,000 up to 300,000 USD. Restaurants, small hotels, clinics, commercial rent. And the last one is medium loans, which are 300,000 to 1,500,000 USD. Hospitals, restaurants, food processing, transporting services. Now, let's look at this number of SME companies which are in Georgia, registered in Georgia. You see here these numbers, and these are the 2012, 2013, and 2014 years. And second one is TBC SMEs, which TBC is our Georgian huge bank, the largest bank in Georgia, TBC SME, and the last one is share. So now let's talk about working capital finance options. What does working capital mean? So working capital is defined as assets minus liabilities, which means the value of what the business currently holds minus the cost of upcoming expenses. To put it another way, if a business has euro 5,000 in the bank but has an invoice from a supplier for euro 2,000, its working capital would be considered to be euro 3,000. What about working capital is seen as working because the business can use it. In other words, it's not tied up in anything. Whether you want to buy stock, invest in business, or take on a big contract, all of these activities require working capital, liquid cash that's quickly accessible. On the other hand, if your business is profitable but has big bills to pay soon, your working capital situation could be worse than it might seem, or could even be negative. Let's look at working capital with an example. A business has calculated assets and liabilities and has established that currently it has 2,000 of working capital. It can use that money to buy a new piece of machinery to scale up operations, or it can keep it liquid as a buffer, a working capital reserve. If it buys the machinery, the business has run out of working capital, or the company's money is tied up. That means that if a bill for 1,500 were due before more cash flow into the business, expenses would be greater than income. This is sometimes called negative cash flow or bad cash flow. On the other hand, if it had kept the 2000 as working capital instead of trying it up in new equipment, the business could pay the unexpected bill and would stay in a positive cash flow position with 500 left over. Now let's see what working capital and cash flow. Working capital is the amount of liquid, usable cash your business has once all assets and liabilities have been accounted for. Money that can be spent at any moment without the need to sell something. Now let's see what is cash flow. Cash flow refers more to the timing of when cash is flowing and in and out of your business and is considered over a period of time. Working capital finance is business finance designed to boost the working capital available to a business. It's often used for specific growth projects such as taking on a bigger contract or investing in a new market. Different businesses use working capital finance for a variety of purposes, but the general idea is that using working capital finance frees up cash for investment in the business, which will be recouped in the short to medium term. What about types of working capital financing? There are 6 types, as you see here. First is working capital loans, second overdrafts, third trade finance and supply chain finance. Fourth one is asset refining. Fifth one, merchant cash advances, and the last one, sixth one, is auction finance. Now let's talk about each of them. First is working capital loans. There are many. Working capital is the amount of liquid. So working capital loans are normally over a short or medium term, designed to boost cash in the business to go after new opportunities. Secured working capital loans will require assets to use as security, so the amount you can borrow is restricted by the assets available. Now, second one is overdrafts. Overdrafts have traditionally been a useful source of working capital finance for many businesses across all sectors, but they're hard to get with a business bank these days. On the alternative finance market, there are lots of flexible business overdrafts, which are a great way to finance working capital at short notice when you need it. The downside of using overdrafts for working capital is that they often have low credit limits, which might limit your plans. They are effectively a form of unsecured lending, so even if you are lucky enough to get one, the limit is likely to be fairly low unless your business has a strong history. What about the trade finance and supply chain finance? It is work in a similar way to invoice finance. They are both types of working capital financing designed for businesses that focus on physical stock rather than services rendered. Supply chain finance is a mutually beneficial arrangement based on the creditworthiness of buyers, where the buyer can delay payment for longer while the supplier gets payment from the lender immediately. The payment delay is shouldered by the lender rather than the supplier. Trade finance is a more complex finance partnership that facilitates international trade and often involves arrangements like repayment for the shipment of goods from overseas manufacturers. Now, about asset refinancing. For many businesses, an unsecured business loan is the best way to increase working capital. But if you can't get enough funding unsecured, you can often use assets in your business to raise finance via an asset refinance. Asset refinancing is based on valuable assets in the business, so you won't usually be required to offer a personal guarantee or involve your personal home. Like invoice finance, the amount you can borrow depends on the value of the items used to secure funding against. Now about merchant cash advances. Merchant cash advances. If your business accepts payment from customers using card terminals, a merchant cash advance is another useful way to increase working capital. The product gets its name simply because it's a cash advance for merchants, meaning business like retailers, pubs, cafes, and restaurants are all suitable. The amount you get advanced is normally expressed as a percentage of your average monthly card revenue, and critically, repayments are taken as a percentage of future card revenue too. That means repayments can feel relatively painless because they are taken at the source. Now, let's talk about auction finance. Auction finance. For property developers, auction finance is a form of short-term working capital financing. Auction finance can also be combined with other types of property development finance. For example, you could transfer across to bridging finance while the building works are being done and exit into a commercial mortgage for the long term. So conclusion are many types of working capital financing available, and choosing the right product depends on your sector and circumstances, as well as what you are trying to achieve. Now let's move on and we see long-term funding facilities. Now, long-term financing is a form of financing that is provided for a period of more than a year, and services are provided to those business entities that face a shortage of capital. There are various long-term sources of finance. Examples of long-term financing include a 30-year mortgage or a 10-year treasury note. Equity is another form of long-term financing, such as when a company issues stock to raise capital for a new project. Now let's see purpose of long-term financing. It's to finance fixed assets, then to finance the permanent part of working capital, expansion of companies, increasing facilities, construction projects on a big scale, provide capital for funding the operations. Factors determining long-term financial requirements. These are nature of business, nature of goods produced, and technology used. Now let's see types of long-term financing. Long-term financing that is provided to a particular company depends on its type. For example, the long-term financing that is provided to a solo proprietorship is different from the one received by a partnership firm. Now let's talk uses of long-term financing. Talk about it. Long-term financing is used in separate ways by different types of business entities. The business entities that are not corporations are only supposed to use long-term financing for the purpose of debt. However, the corporations can use long-term financing for both debt and equity purposes. For example, sources of long-term financing: shares, debentures, public deposits, retained earnings, term loans from banks, loan from financial institutions. Now let's talk about each of these. Let's talk about shares. These are issued to the general public. The holders of shares are the owners of the business. These may be of two types: equity shares and preference shares. Now about debentures. These are also issued to the general public. The holders of debentures are the creditors of the company. What about public deposits? General public also like to deposit their savings with a popular and well-established company, which can pay interest periodically and pay back the deposit when due. Retained earnings. The company may not distribute the whole of its profits among its shareholders. It may retain a part of the profits and utilize it as capital. Term loans from banks. Many industrial development banks, cooperative banks, and commercial banks grant medium-term loans for a period of 3 to 5 years. Loans from financial institutions. There are many specialized financial institutions established by the central and state government which give long-term loans at reasonable rates of interest. Now, as you see, here are credit review process steps. So let's see, what is the review process? First is, how does the review work? Let's see. The credit review office's role is to provide an independent, impartial opinion on the credit decision. Our review will be based on the viability of your business and its ability to generate sufficient cash to repay the debt. Second is the process. Is the process confidential? Yes, your application will be treated with the strictest confidence. How long does the review take? The time taken to complete the review will be influenced by factors such as the complexity of case, whether an internal appeal has already been completed, and the ability of all necessary information. A 4 to 6 week turnaround between our office receiving the application, the bank responding, and the credit review office issuing an opinion would be typical. You can contribute to the processing speed by ensuring that your application and consent form have been fully completed before submission. What happens if the bank's refusal is upheld? If in some cases may form the opinion that even with the proposal the lending, the business would not generate sufficient cash to repay the loan. In these instances, we do not recommend additional credit, as the additional repayment would further drag the business down. Who will carry out the review? The review will be carried out by one of the credit review panelists, all of whom have significant frontline SME credit experience. In addition, an accountant with commercial evaluation skills from the public sector will join all assessment committees. Care will be taken to ensure that the credit reviewers have no previous connection with either you or your bank. What issues are considered? The issues that may be considered as a part of our independent review include the promoter's experience and capability, whether the market being addressed is growing or declining, past business performance, historic profit cash flow, future potential projected profit cash flow, the sales pipeline, steps taken to improve your business situation, performance against projections to date, the situation regarding aged debtors and creditors, and the promoter's assets and liabilities. However, this is not a definitive list. The issues considered will be determined by the individual case. What is the outcome of the review? The output of our independent review will be in the form of an opinion. This will typically run to 5 to 6 pages with recommendations for both you, the borrower, and the bank. If the appeal has been successful, the opinion will also include an outline of agreed next action from the bank. This will list out the next steps and conditions required to ensure that your business gets credit. This is the review process. So now let's talk about venture capital and private investment. What is a private equity? Private equity funds invest and acquire equity ownership in private companies, typically those in high growth stages. These private equity funds purchase shares of private companies or those of public companies that go private and become delisted from the public stock exchange. Their There are various types of private equity firms, and depending on strategy, the firm may take on either a passive or active role in the portfolio company. Passive involvement is common with major companies with proven business models that need capital to expand or restructure their operations, enter new markets, or finance an acquisition. While active involvement does not mean the private equity firm runs the company on a day-to-day basis. It does mean that the firm plays a direct role in restructuring the company, reshuffling the senior management, and provide advice, support, and introductions. Now let's see what is a venture capital. While venture capital is a subset of private equity, there are differences between the two. The most notable difference is that venture capital funds raise capital from investors to specifically invest in startups and small and medium-sized private companies with strong growth potential. Venture capitalists focus on sourcing, identifying, and investing in what they believe are entrepreneurs and startups that will succeed and bring large returns later down the line. Depending on the venture capital partner's expertise, venture capital funds have an industry or sector focus. Now let's see a typical private equity and venture capital fund structure. Excuse me. Private equity and venture capital fund structure looks very similar in the way they are structured. Below highlights a typical public private equity and venture capital fund structure. As you see here, there is a general partner that provides capital advice to introductions. Yes, and the second one is limited partners. Provide limited partners, which includes family or offices, pension funds, foundations, endowments, fund of funds, Soviet with wealth funds, high net worth individuals they provide capital. So now let's move on and see the fundraising. Let's talk about fundraising. So, raising money is hard, and when you are relatively new to the process, it's easy to be confused by the process. There is all sorts of advice on the internet about how to raise capital. Of course, much of it is conflicting. Fundraising, as is much of life, is a sale, pure and simple. The sooner you understand that, the sooner you can plan your campaign. As with any sales campaign, you need to qualify your buyers early so you focus your scarce resources on people likely to buy your product. Spend time researching your buyers and not just pitching them. Call high. Partners make investment decisions. Meet in person. They are not buying a book on Amazon or shoes on Zappos. They are buying you, and that doesn't work remotely. Build a relationship with your investors over time. People buy from people they like. Trust, respect, and belief. Trust doesn't come from one 35-minute PowerPoint pitch or 30-minute demo. Create scarcity. 3 rules in sales. Why buy anything? Why buy me? Why buy now? The hardest is the last. Why buy now? People avoid difficult decisions until they have to make them. So here you see 10 advice on fundraising. It is really useful advices. First one is identifying the right target investors. Let's talk about it. Every investor is different. Focusing on too many is a mistake. You want to narrow the suspects into a group called prospects. These are people with whom there is a likely match for your product or service. This narrowing follows the 3 golden rules of sales: qualify, qualify, and qualify. Second one is determine how to get access to them. Now, in the area of social networks, LinkedIn, Facebook messaging, and email addresses that are easily guessable, of course. Third one is meet early. There is the school of people who tell you that you should only meet with venture capitals when you are ready to raise. Their arguments are: first, fundraising is too time consuming and meeting early is wasting time. B. The venture capital will get a bad impression of you and you should wait until you are on your best footing to raise. Both of these arguments are logical and thus many entrepreneurs buy them. They are both flawed though. Fourth one, as you see here, is press the flash. It's tempting to want to stay in your offices and fundraise via email or web conferencing, but fundraising is a contact spot. You've got to get out there and shake hands. Raising money is a direct sale, not a telephone sale. They are buying you, so interacting with you in person is paramount. So now let's see fifth one. Have a narrative. Make it simple. Nobody will buy what they don't understand. It's your job to take the complexity of your company and industry and develop a narrative that helps investors better understand the context. It's basically storytelling. Sixth one is create a sustained campaign. Many people equate a great pitch meeting with success. They can lament the fact that the process died shortly thereafter. All sales campaigns are processes that occur over time. It's your job to find a continued way to stay on the radar screen of the venture capital. You had your great meeting. If it felt great, it probably was. But in the 3 weeks since your meeting, that venture capital has seen 12 other companies, had 3 board meetings, and had to deal with some inquiries from its own investors. So, when you are wondering what they are thinking about, unfortunately, it's not likely you. Think about it this way. You were a priority when they agreed to meet you, but since then they've been putting out other fires. If you start to think of venture capitals as a person who might buy your product, then you can plan your sales campaign accordingly. Seven, seven is a lobby. If the best intros to venture capital come through qualified referrals from people they trust, then it follows that the best way to keep venture capitals interested in you is to have similar people tell them how great you are. So determine the venture capitals you want to influence. Identify who influences them. Figure out how you are going to get these people loving your product, your company, and you. And then ask for their help in reminding the venture capital how great you are. Se- so let's talk about now 8. Recognize that fundraising is a part of your ongoing duties. Always be fundraising. It's just a part of your ongoing activities as a founder. Sure, you might not like it. It might not seem core to your business success. It is. Building a business is not about only building a product and seeing if customers like it. You can't just do those things in business that you enjoy. Make fundraising a habit. Don't only engage every 18 months. 9 is take appropriate risks. Remember those 3 rules of sales. Remember it. Why buy anything? Why buy me? And why buy now? Well, if the why buy anything is testing whether you are even compatible with the venture capital, the why buy me has got to be extreme differentiation. Venture capitals seek companies all the time. They all start to sound the same. Behold, make your positioning strong, stand out. It may turn off some venture capitals, but for others it may be a positive. So the last one, 10th one, is understand the importance of marketing. Nobody thinks they are influenced by marketing. Everybody is, even if it's subconscious. We tend to be more excited about things that we read in the press and or articles being forwarded to us by our peers. It's human nature. So make sure you have a solid PR strategy. It was really 10 good advice. So let's remember. Now move on non-financial services. Short courses to improve SMEs business management skills are non-financial services. The goal of short courses are improve SMEs business management skills. Second is promote communication and information interchange between SMEs. Now let's see trainings. Trainings are of course very important. The goal of it is improve SMEs business management skills and promote communication between SMEs. And now let's see what trainings are, what it includes. Here is CVP analysis and budgeting. Cost, it includes cost classification, profit forecast, short-term and long-term decision making. Second one is social media marketing, which includes planning the internet marketing campaign, evaluation of the campaign result, cost minimization. Now move on and see third training, HR management, which includes topics, recruiting, setting the goals, staff valuation techniques. The fifth training is strategic management, and the last training is budgeting, which include topics as planning, executing, and control. Now, I will tell you that educational web platform is very good thing for SMEs, where business owners and managers can find articles, forms, calculators, and other useful information concerning the following main fields: accounting and finance, business planning, human resources, legal issues, marketing and sales, operations management, technology, and others. So you can visit the site sme2kit.org and just look through these topics. I think it will be useful. Thank you very much for your attention. If you have questions, you can contact us on email. Here is written our email, webus@caucasus.net, or the second mail, as you all know, you can contact there too. Hope our presentation was useful for you. Thank you. Bye-bye.